Hi everyone. Good evening and a warm welcome to today's webinar. My name is Jyotak Nandwana and I'll be hosting the webinar. So our topic for today is understanding choppy markets, and before we begin our webinar, I would like you to spend some time on reading the disclaimer. So it says that stocks that we'll be discussing in today's webinar shouldn't be considered as a recommendation. All information is for educational purposes only and in no way should be considered as investment advice. All right, so this is going to be our agenda for today. And as always, we'll begin with discussing about the current market before we move on to our main topic, that is choppy markets, understanding choppy markets. And we'll have a few aspects where we'll give information about how to identify choppy markets, what are choppy markets, and what should be our approach in those markets, and how should we go about managing our portfolio, what is the importance of taking pilot positions in such markets, and what should be our risk and reward in those markets. And also we'll be having a dedicated Q&A session towards the end of the webinar, and I would request all participants to keep their queries reserved for this session because so as to maintain the flow of the webinar. However, in case you have any query that is very specific to the slide of discussion, you can always raise your query through the chat box and I'll be happy to answer it. All right, so this is how the Indian market is looking as of today, and we are in under pressure right now. So the market condition was changed to uptrend under pressure on May 18th, and the main reason for that was there was a buildup of distribution that we saw. So high volume selling on Nifty as well as Sensex. So the current distribution count is 4 on Nifty and 2 on Sensex. It's not a very high count, but what we have also seen is a couple of stalling days. So stalling days is basically when index, after making good intraday gains, it gives up all those gains and it closes near the day's low. And also the volume is higher than the previous day. So this indicates that there is some selling, institutional selling, high volume selling going on in the market, and is generally a sign of weakness. So we have had 4 distribution days on the Nifty. On top of that, a couple of stalling days as well in the previous 5 weeks. So the market condition stays at under pressure for now. Now we have seen a few macro conditions also weakening in recent times, and the rupee depreciation, the increase in crude oil prices, and of course the rising bond yields both in the domestic as well as international markets. And then we had political uncertainty also. So all these factors have played spoil sport and kind of put brakes on the market uptrend, which was very strong and had continued from December 2016 till January 2018. However, of late, in the last 3 months, the market have come under pressure, and the main reasons for that, we have seen some macros getting weaker. Now, in against this backdrop, what we have also seen is the foreign institutional investors have reduced their exposure in the Indian market. Of course, the rupee depreciation hurts their investment returns, so they need to take into account not just the appreciation in the equities, but also how the currency is moving, and the rupee depreciation has not uh, gone down well, and we have seen foreign institutional investors reducing exposure and withdrawing close to 20,000 crore in just the last 2 months. Okay, so just want to check if all of you can hear my voice. All right, so most of you can hear my voice and can see the video clearly. So in case if you're having any issue, I would request you to re-log in, check your settings once, and there could be an internet connectivity issue. So request you to re-log in once. All right. So as I was saying, the foreign institutional investors have reduced exposure and they have sold a huge amount of money. So that's around 20,000 crores in the last 2 months. And one positive that has come during this period is that the domestic inflows have been really good and they have kind of supported the market. So even though the markets are under pressure, the key indices, Nifty and Sensex, are not very far away from their all-time highs. You can see that uh, Nifty and Sensex are just around 4 to 5% below their all-time highs. And so on the large cap front, it's not looking too bad as of now. And we have seen strength mainly in the IT and consumption-oriented companies in the recent past. Right. So that could also give us a signal that most of the smart money is moving in defensive sector, and it might not be too good from a broad level perspective. Now, in our previous webinar, in which we had also talked about mainly about the market condition and how the Indian market is shaping up, we had talked about that the market is looking very divergent. We can see a lot of divergence in small cap, mid cap, and the large cap. So, as I had said, that the large cap index, they have corrected just 4 to 5% from their all-time highs. However, in mid cap and small cap, it's a different story altogether. And of course, with the market condition as well. So we are tracking mid cap and small cap index as well, while the market direction is mainly determined using the frontline indices, that is Nifty and Sensex, but we also keep a track of mid cap and small cap as well. So the Nifty mid cap is below its 50 and 200 day moving averages. So that's something which is really weak, but there is some strong support at the 18,300 levels. So the index was able to rebound from those levels this time around as well. However, the overhead supply, so the correction that we have seen from all-time highs is around 13%. So overhead supply is pretty big over here, and you can see that the correction that has happened, it's almost 13%. But one weakness that we have seen in recent times has been the number of breakouts. So the number of stocks that are breaking out of base patterns has actually dried up, and that is something is that is something which is very weak and it should be paid attention to. So we had highlighted this point in our previous webinar as well. Now moving on to, so mid cap index, if we talk about market condition, the market direction is currently, it's in a rally attempt because okay, so I think it's just one user who's facing an issue. I hope all of you can hear my voice clearly. Okay, so I'll move forward again. Yeah, so talking about market condition, if we have to go by Nifty mid cap, it's currently in a rally attempt, and we looked at key index which were in under pressure. So this is the divergence that I was talking about. And in the small cap, it's again a different story. So in the Nifty small cap is actually in a confirmed uptrend. Now, why is that? Because we had a follow through day on May 25th, and before that, you can see that the index was able to hold above its bottom for 3 straight sessions. And I'll just quickly highlight that for you. So you can see that the index was able to hold above its bottom for 3 straight sessions, and then we had a very strong up day, and the volumes were also higher than the previous session, and that's what we call a follow through day. So that the gain was 1.5% on Friday, and we moved Nifty small cap into a confirmed uptrend. But again, you can see that there is a huge overhead supply. The index is down 18% from its January highs, and that is something which does not looks too comforting. And even though the Nifty small cap is in a confirmed uptrend right now, we still remain cautious looking at how the overall market is looking at the number of breakouts that we are seeing on a weekly basis. So that is something which still is not looking very fruitful to us right now. So keeping a track of weekly stock breakouts, you can see how the number has been reducing in the recent weeks, and you can see how it has come down from almost levels of 40s to just 9. And even in the current week, we haven't seen many stocks that have broken out. And as a side remark, I was looking at the number of stocks that are below the 50-day and 200-day moving average. That number itself is also not looking very good right now. So the universe that we have is of around 800, 900 stocks, and of that we have almost 500 stocks which are below their 50-day lines, and 400 stocks which are below their 200-day moving averages. So this is something which is not looking very bright in the markets right now. And of course, looking at the number of stocks that are breaking out of their base patterns, you can clearly see that there has been a dry up, and from the levels of 30, 40s, we have come down to single digit. And that is something which is, of course, can be attributed to the weakness in Nifty Small Cap and Mid Cap mainly. So the overall conclusion of the current market condition would be that we can continue to go by the movement in large cap indices. Of course, the Nifty Small Cap has made its way into a confirmed uptrend, but again, if we look at the number of stocks that are breaking out and the leading stocks, how those are doing, we do not see a lot of strength in the market right now. Yeah, so there's one query with respect to follow through days. So since DS has a query that since small cap index is high beta, shouldn't the threshold for its follow through day be high, like 1.75 to 2%? I think that's a very good question, and that is something which certainly will also give us an idea going forward if the current follow through day fails. But historically, what we have seen is a day when there is a gain of 1.5%. That is something that has worked well for the market. But again, that is something that keeps on changing from years, because there could be a change in volatility, that could be a change in how the overall market is behaving. So this is something which we continuously track, and if we see that a lot of follow through days which we had seen because of our criteria of 1.5% gain are not working, we'll obviously revise it, and we might move it to 1.75% or even 2% for a small cap index, which is a high beta one. All right, so that was a brief about the current market condition, and let's move on to our main topic, which is understanding choppy markets. So if we look at the long-term chart of the markets, we all know that markets have an upward bias, and over a long period of time, markets always go up, and that's pretty straightforward to all of us, mainly because if the economy is doing well, the companies will do well, the companies will keep generating profits, the earnings growth will come in, and of course the markets will keep doing well. But that's again in a very, very long term. This is the monthly chart of Nifty, and we can see that how the upward trend has been maintained. But then we can always get some nasty corrections, like the one which we saw in 2000, the one which we saw in 2008, and then there is also periods of the market doing really well, and we have clear uptrends like the one over here, the 2003 to 2007 rally, and we also had a very good period over here, which was mainly attributed to BJP coming back into power, and we had, of course, a very nice, good period of market uptrend over here as well, and there was a brief correction mainly on account of demonetization. So as you can see, we had a couple of really bad corrections, but then in between we had some really good periods of uptrend. But what is really dangerous over here is the market correction, not the market correction, but the choppy markets. Because what happens when the markets are in uptrend, with our market direction model, you'll know that it's time to go all in and keep buying high quality stocks that are breaking out of base patterns. And when the markets are in downtrend, you can obviously get out of the market much earlier, as in when the market starts to weaken. But it's during periods of market choppiness then that is when the markets are struggling for direction. Over here you can see, and this was also somewhat a really choppy period for the market, and you can see that how the last 3 months have been really choppy, and the market hasn't made any progress, and also it has been struggling for direction. Right, so these are the periods which will test investor patience, and the whole point of this chart is the investors can think that since the market goes up over a long period of time, why not one should be long for a long period of time. But then again, this is an index chart, and with stock specific, you can obviously have periods of huge drawdowns or even underperformance on the fundamental perspective. You're not 100% sure whether a company will always generate good returns for you over a 20-year period or not. So the point that I wanted to make with this long-term chart is that the choppy periods are periods when the market really tests you, and those can be most dangerous because you won't be able to make money always. Your hit rates will go down, and what happens in those periods is that by the time you start feeling really bullish about the markets will turn, and they will turn weak, and by the time you start feeling bearish about the market, and you would think that it's time to get out of the markets will surprise you and turn strong. So that's the reason why those periods are really testing times for investors. All right, moving on. So what is a choppy market? So that is something which investors would like to know. What is a choppy market? So basically, major indices, they get stuck in a range, they trade in a range bound manner, and oftentimes what will happen is the indices will trade between their moving averages. So this is something which had happened in 2015 as well, when both Nifty and Sensex had kind of traded between their 50-day and 200-day lines. But this is something which is not happening right now. But even then, the markets are quite choppy, as in you can see that the day-to-day swings are pretty large, but over a medium-term period, the markets will not make much progress. So you'll see a lot of days, a lot of sessions when the market is going up 1%, the next day it's coming down again 1%. So the day-to-day volatility will be very high, but over a period of say 3 to 4 months, the markets will not make much progress. I'm not sure. A few users are facing issue with respect to the screen. Just wanted to check if you're able to see the screen clearly. Okay, so I can see that most of the users are able to see the screen clearly. And I'll just share the screen once again with you all. Okay, so I think it has to do with some connectivity issues, because a majority of our participants are able to see the screen clearly. They are able to hear the voice as well. Right. So in choppy markets, as I said, that the progress that the markets will make will not be much. So they will remain sideways, and these will be the periods when the markets, after hitting a bottom, will come back up again and then again face resistance and go back down again. So this has been happening for the Indian market as well. So if we talk about Nifty, I think the levels of 10,400 and 10,900 on the upside are where the index has been trading for quite some time. And you'll also notice is that there will be a lot of fake outs. So fake outs in the sense that the breakouts will not work both in both directions. So there could be a breakdown also. So people who use technicals to short stocks will find that those might not work. And even on the long side, you will see that the breakouts, the stocks which are breaking out will give up their gains and might not perform well in the near term. So this is something which has also happened in our model portfolio as well. There were quite a few stocks. So when I had showed that slide to you in which we saw, so I'll quickly go back to it. So there were a lot of stocks that had broken out in the month of April, and yeah, and we had also added a few stocks in our portfolio, but as soon as the market started weakening, and so ultimately we realized that those were kind of fake outs, and since the markets are choppy, the number of breakouts that will yield good returns in the near term has the probability has gone down, and the hit rate will be impacted. So that is something which will happen in choppy markets, and these are the characteristics of a choppy market. Now, how do you identify a choppy market? Now, if you look at, so this is the daily chart of Nifty, and if you see historically, so you can see how in the past 1 year, the index was in a clear uptrend, and there were times when the index was able to get support at its 50-day line. So the red line is the 50-day line, and you can see how on multiple occasions the index found support at its 50-day line. Of course, there were a couple of times when it breached it and was able to bounce back from it quite quickly. So this is what had happened in the market last year. But then you can notice that there was a character change in the index. You can see that there was a break in the channel line. So the upward channel line was broken. The market got really euphoric. You can see how the slope got very steep over here. So this was the period when the markets were really euphoric, and this was in January. And even though the market had hit a new high, one could have easily seen that there is something wrong that has happened in the market. There is certainly a character change, and that is one key parameter that will help you, that will always help you in identifying a choppy market. So after that, of course, I'm not saying that when you see something like that, you should completely get out of the market. What I'm trying to say over here is there were clear signals that the market character has changed. And when you saw a lot of distribution days happening over here, the key index breaching its 50-day line and not being able to come back above it. So it tried on multiple occasions, but it failed, and it never was able to come back above it. So that really gave you a signal that the uptrend has been broken, and the market, which was really doing well since the past 12 months, is now in some trouble. So all those signs were really clear, and these are the ones which you need to keep a check on whenever you want to identify a choppy market. And now you can see that how the market has become really volatile. So how you can see how the down days, there have been really wide and loose price swings in the market, and even on the upside. So we have few days when on 5 to 6 sessions the market keeps going down, and then the market makes a good comeback. 5 6 sessions it goes up, and then again. So these are the times when the market becomes really choppy, and it is always something which happens after the steady trend has been broken, and we had a big sell-off over here, and there was a breach of 50 DMA, as I said. So since then, market has been really volatile and has been struggling for direction. So that's how you can identify a choppy market. Mainly, there has to be a character change in the market. Now, how do you move along in such a market? Now, you need to be honest with yourself. You need to realize that the market has changed its character. Now we all want to make money in the market, and what we all want to do is make money every day in the market. We really feel good when we see our stocks going up, and feel more bad when the stocks come down. So, but we need to be realistic. This is something which is not going to happen uh, every time. Of course, we had a really great period in 2017, but these periods do not last for a lifetime, and there will always be volatility in the market. And the current one is something which is, of course, going to test a lot of going to test patience of a lot of investors. So you need to stay patient, and you need to understand, if there is no money to be made in the market, you don't try to extract money. and we must take what the market gives us and don't force it. By saying don't force it, what I mean to say over here is that even though if you see few of the stocks that are making new highs and that are breaking out, until and unless those stocks have exceptional fundamentals, they have exceptional technical strength, make sure you don't get into it. These are some of the mistakes that were also committed by us recently. So we had few stocks which, even though those stocks broke out and were looking really good in terms of technicals, we could have stayed on the sidelines thinking that the market is looking divergent, market has become choppy, let's only concentrate on the ones that are really exceptional. So the ones that are really exceptional, which we had added the names such as Nestle India, Bajaj Finance, all those have done really well for us. But then there were some that did not do well, and those were mainly from small caps and mid caps. And these are the ones, high beta names, where the probability of an investor getting shaken out are really high. So you need to stay patient. You need to give the market the due time it needs to come back again, and no need to force trades. But having said that, you shouldn't get out of sync of the market. You need to stay in tune with the market. All you need to do is be a little, be less active, but make sure that you're not getting out of touch of the markets, because what happens with market is if you get completely out of touch and suddenly the market will not, ring a bell saying that, okay, so we are back in an uptrend, so start accumulating stocks and all that. Of course, our daily big picture notes will certainly help you to keep in touch with the market. But what happens with choppy markets is a lot of investors get disinterested in the market because they have got used to making gains in the market, and they don't like making losses. So they get out of the market and then they never come back. So make sure, even though you're less active, make sure that you don't get completely out of touch of the markets. All you need to do is uh, read our daily big picture. It's a 5-minute quick read which summarizes the market condition for you. So that will give you a fair idea as to where the market, what the market is doing right now. And one more thing that you need to do, and you can do this on a daily as well as weekly basis, is keep updating your watch list. Keep looking at the names that are acting strong, that are doing well in the current market. The relative strength will be high. Of course, we want to see earnings also good. So EPS rank has to be high. All those parameters are there in MarketSmith India tool, and you can keep filtering stocks and maintaining your watch list. So preparation is very important when the markets are choppy. And what tends to happen in such markets is that people start predicting. So you will see a lot of contrasting opinions that will be going on here and there, where some might be saying that the market is headed for new highs, while some might be saying that the market is headed for a crash, because nobody is sure as to what's going to happen. So this is a period where a lot of contradicting opinions will be out there. But what we need to do as rational investors is keep focusing on preparation and not get into the prediction business. We need to interpret what the market is telling us. There will always just be reasons for the market to go up, and there will always be reasons for the market to go down. But at the end of the day, what we need to understand is how we interpret the overall market perception. And that's the reason why the market direction model is very important, because you're keeping an eye on the daily movement of mid cap, small cap, frontline indices, and that's how we assign a market condition. So in a nutshell, the focus should be on preparation. You're preparing your watch list, you're looking at the daily big picture and trying to understand, trying to interpret what the market is telling us, rather than predicting where the market is going to go in the coming future. So we don't know what's next, and to be successful in the market, that is something which is not required also, that we always know what's going to happen next. So without that also, people have made money in the stock market and people continue to make money in the stock market. All you need to do is stick to a process that works for you. And CanSlim is a methodology that has worked for years, and over 60 years it has worked for William O'Neill and most of the individual investors. So you need to stick to a process. You need to keep refreshing your watch list, keep identifying stocks. This is a very good period because a lot of companies have also reported their earnings, and a lot of companies will also come out with their annual reports in the coming weeks. So while the market is not doing much and there are not a lot of ideas that are coming in the market, you can always use this time to build knowledge about the company that you really like, build knowledge about. So after you have screened your watch list, you can always read more about that company in detail, and this is the time to be doing that. Now, coming back, why you shouldn't be predicting is because a pullback, if you see an index has come down by 5 to 10%, now that could be a normal pullback in a bull market, and it could also be a beginning of a bear market. So that is something which nobody can predict. So that's the reason why you need to keep an eye on how many distribution days are being accumulated. So as we have seen that while FIIs have been continuously selling, the DIIs have been supporting the market. So the distribution buildup is not too high, and that's the reason why we have still kept the market in an uptrend. Both frontline indices, Nifty and Sensex, are above their 50-day and 200-day moving averages, and still the market is. That's the reason why the market is still under pressure. Now, once you become detached from the predicting game, you will always feel liberated. You will feel more easy about your process, and that's what we need to do. And that's the reason why we need to be in the interpreting game, and not in the predicting game. This is something which William O'Neill has said for years. Right. So this is an enlarged version. So this is a chart taken from our mobile app. So this will give you a very good idea as to why we have been saying that the current market is being really choppy. Now you can see that after breaching its 250 and 200-day moving average, we can see that the index has done well to retake it in a very short span of time. But then again, it has built some overhead resistance, which it is finding hard to overcome. And of course, earlier we had discussed how the macro conditions have also weakened. So that is something which is also keeping a lid on the market. Right. So we had a pullback, and we had almost fallen 10% from the 2000 January highs, and we then again had a follow-through day as well. We saw many stocks breaking out, but most of them gave failed breakouts. There were fake outs as well, which trapped both long and short positions in the last 3 months. So this is all these things certainly give a signal that we are in a choppy market right now. And with respect to follow through day, while we had a follow through day on April 5th, if I'm not wrong, and after that the markets did really well for 3 to 4 weeks. But we need to understand that all follow through days will not work. That is something which we need to understand. But also keep in mind that no bull market has ever started without giving a follow through day. So that's the reason why even when I saw a follow through day on Nifty Small Cap, looking at the overall picture, looking at the market spread, we still remain cautious. We have made few additions in our portfolio, but we are making sure that we are sticking only to high quality and not very high beta names. The beta should be at a manageable level. Now, when you see a follow through day, what you need to do is make sure that you're not going all in into the market. So if you have a portfolio of say 10 lakhs, make sure that you're not investing right away the whole 10 lakhs in say 2-3 stocks which have broken out. What you need to do is slowly get into the market, build your position slowly, and you need to give market the time to confirm that the picks that you have made are correct. So the key points that the key takeaways for a choppy market is that make sure that you're not very rigid in your market stance. Make sure that you're not thinking in terms of, you're very bullish about the market. The market by the end of this year will Nifty will touch 12,000 or 30,000. Make sure you're not thinking on those lines. And of course, on the flip side, you're not saying that, we are heading for a bear market. Crude oil has increased. There are concerns that India will overshoot its fiscal deficit target. Current account deficit will widen. Rupee will depreciate, so its FIIs will not come in because there's a rupee depreciation happening. The bond yields are going up, so money will move from equity markets to the bond markets. So all those things You need to make sure that you're not extrapolating a lot. Make sure you're interpreting what the market is telling you on a daily basis, and that's where the daily big picture will help you. A quick summary as to what the market has been did over in the session gone by. Now, you need to pyramid in and out based on what the market and even your portfolio is telling you. So if you see a lot of stocks in your portfolio that are weakening, so as I said that we see around 500 stocks that are trading below the 50-day lines in the current market. So out of our universe of 800 900 stocks, so almost 60-70% are below the 50-day line. So that is a weak signal right now which we are seeing, and even on the 200-day lines we have seen almost 50% stocks have breached their 200-day moving averages. So you need to make sure what your portfolio is telling you. So if you have names like the ones which we have in our portfolio, say Edelweiss, which even made a new high in today's session. If you have such names in your portfolio, you can stick to those names because those are high quality ones. Even in weak market, such stocks are able to make new highs. So that is something which is really positive. But if you have names in your portfolio that are breaching 50-day lines on heavy volumes, that are going below 200-day lines, you need to make sure that you're getting out of the market. Okay, also, as I have said a couple of times, the big picture reports and the weekly stock breakouts will always give you an idea as to what the market health is looking like. And in your free time, you need to keep screening stocks using the Filter India Stocks feature, and that will give you an idea. That will give you an idea as to what are the stocks that are setting up well and are looking good from future leadership perspective. Now, when I said that when you see a follow-through day, you need to get into the market slowly, and that's where the importance of pilot positions comes in. I had told you that even though if you get out of the market, make sure that you are in tune with the market. Make sure that you are reading what's happening in the market on a regular basis. And many of the investors find it hard to do because once you're out of the market, you are holding no stocks. What they feel is I'll get back only when the market improves, and by the time market improves, most of the stocks will already go up a lot. So make sure you have a little bit of exposure in the market. Maybe you can hold few shares, 5-10 shares, not much, of a particular stock. And of course, if you have stocks like Edelweiss and KI Industries, which are still trading near their all-time highs and have done pretty well, while the mid-cap and small-cap indices have corrected a lot, such stocks will always make sure that you stay in the market and you have some exposure in the market, because the market will not ring a bell when it is ready to go up again, and that is the time when a lot of investors will miss out on some good returns. Also, you shouldn't get flat-footed because yeah, you shouldn't get flat-footed that the market is looking really bad, and you need to be flexible, and you need to keep an open mind and look at what the market is telling you. Because what usually happens is the market gives its best performance when the crowd has lost interest. So when most of the retail participants lose interest in the market, that's when the markets turn, and also they turn when the news looks worst. So that's also something which has happened in the past as well. Now, this is one quote which aptly summarizes what you should be doing in a choppy market. So this is a quote by a famous hedge fund manager, Larry Hyde. I have two basic rules about winning in trading as well as in life. If you don't bet, you can't win. If you lose all your chips, you can't bet. So you need to keep in mind that choppy markets are the times when you need to preserve your capital. Make sure that you're not losing all money in the market, because if you see that, suppose if you have if you see a good stock breaking out and if you build a position in it, of course you will do some research on it. If it's a model portfolio stock that we have recommended, you will see our edition report, and you will do further research also and get into it. But after all that, if the market is not doing well, and if the stock corrects a bit, if it reaches its 50-day moving average, from model portfolio perspective, we'll always remove that stock, citing that the stock has breached our sell rule. And that is something which you also need to do as an individual investor, because one thing that you need to make sure is you need to stay in the game always, and you'll always be able to stay in the game when you are able to cut your losses. So one of the examples that I can quickly talk about is Tirumallai Chemicals. The breakout did not work. The company reported below expected numbers in Q4, and the stock almost corrected 30% from its highs. So we made sure that once the stock has breached our stop loss rule of 8%, let's get out of it. We can always come back into it when it breaks out of a fresh phase pattern. So don't make those mistakes of holding on to stocks even those losses have accumulated to the levels of 30-40%. Don't make those mistakes, because we don't know when the market will recover, when the stock will recover, when will it break out into new highs again, and it will test a lot of patience for you. And of course we can also have some extreme cases, like we have seen in case of Manpasand beverages, what has happened, and the stock has hit back-to-back 20% lower circuit in 2 sessions. So that is something. Obviously technicals will always give you signs that there is something wrong that is going on, and with Manpasand also it has happened. So the idea behind winning in markets is that in choppy markets especially, is the idea is not to make a lot of money, not to make a ton of money, but to stay in tune with the market and to preserve your capital. Now that brings us to managing risk and reward, because in choppy markets, how do you manage your risk and reward? So one thing that investors can do in choppy markets is trim your expectations a bit. So in model portfolio perspective, in Cancelam, we do follow the rule of booking profits at 20-25% level and cutting losses at 8%. But in choppy markets, you can be a step ahead, and you can always trim your expectations and set profit booking targets of say 10-15%, and on the downside 3-4% losses is something which you can place your stop loss at. So that is something which we can always do in choppy markets. And of course, when the market reverses direction, when the market changes its trend, your focus should be on getting the bat on the ball. So in terms of cricket, we can always think about, as and when you see a weak bowler coming in, you might want to hit a six. But what you need to do is, after some good overs, what you need to do is make sure you're getting the bat on the ball. And once you gain confidence, so that's what you want to do in the market as well. So get into the market slowly. Once you see that the market has really changed direction, the market is confirming your picks, you can then go all in into the market. The reason I say that is because the most of your money that you'll make in the stock market is when the market is in an uptrend. So make sure that you don't get into the market too early and you plunge all of your money when it is still, the uptrend is still not clear. And finally, you need to stay positive, because such periods, when the markets are choppy, such periods do come in the markets. We had those periods in 2015 and 16. But the best investors, what they do is that they look at corrections as opportunities. As I told you, this is a period when you can build a lot of knowledge about the companies that you have held in the past, about the companies that you currently hold. And with a lot of companies coming up with their year-end presentations and annual reports, that is where you can search for a lot of information and build knowledge about the companies. And of course, your watch list will certainly help you in screening stocks. With MarketSmith India, you will be able to do that in a few seconds time. And once you have built a watch list and keep updating it and keep reading about what's great about the company. So that's about risk and reward in the current market. And that was the main session that we had today. And now let's move on to the Q&A session. I'm sure you will have a lot of queries with respect to market direction, with respect to your stocks. So what you can do is you can send in your queries using the chat box, and I'll be happy to answer them. I'll also try to answer those by explaining you the stocks on our product. Okay, so there is a query on stop loss rule. So Amit has a query saying, can you elaborate on 8% stop loss rule? What is the base current market price or buying price? So Amit, this rule has been back tested on all big winning stocks. So what William O'Neill did was, when he was researching all those past big winners, he saw that most of the stocks after breaking out of a base pattern did not fall more than 8% from their pivot price, the ideal buy price, and that's the reason why we follow a 8% stop loss rule. So I'll just quickly share and give you an example using MarketSmith India. All right, so if we go to a stock that broke out recently, which is Edelweiss. Now you can see that after breaking out of a consolidation based pattern, the stock has somewhat remained in its ideal buy range, and those zones have been marked over here. So the blue zone is the ideal buy range for a stock, and the red zone is the loss range. So what happens is, after breaking out, if a stock falls more than 8%, so that's a failed breakout from canceling methodology perspective, and you need to get out of it. So that's the reason why we follow a 8% stop loss rule. Okay, next up is a query from KN regarding Titan. So what are your views on Titan? Okay, so Titan is a part of our model portfolio. We have been holding on the stock for quite some time, and if you look at it, it is currently building a base pattern. What a good thing about Titan, which I can see over here, is that it is trading in a very close range. I would like to see the stock getting back above its 50-day line, because uh, all good quality stocks, they spend a lot of time trading above the 50-day lines. And when those stocks reach 50-day lines, and if they trade below it for a long period of time, it certainly suggests that those stocks might be in for some consolidation or sideways movement. Now, if you look at Titan, it has given good amount of returns in the past 1 year, one of the biggest winners in 2017. And even though the company reported really good results, what I see over here is the stock is facing some resistance at the levels of 1000. And if you're currently not invested in Titan, maybe my suggestion would be for you to wait for the stock to break out into new highs again. You can always get back into that at that time. And since the market is also not, it's not giving clear signs of direction right now, you can kind of stay away if you're not invested in Titan right now. But if you're a current investor in Titan, if you see that the stock is trading below its 50-day line for 4 5 weeks and it's not able to get back above it, you can kind of trim your positions. If you're sitting on a huge gain, so if you're sitting on say 100%, 70 80% gains on Titan, the ideal way would be to keep holding on to it, keep sit through this consolidation period. And if you see that the stock reaches its 200-day line, or a really weak signal happening in the stock, then that's the time when you can consider getting out of it. So for now, Titan is a hold. All right, so right, so there is one query from Marish regarding how to select script in Choppy Market. So what I do during Choppy Markets is, when the markets have gone down, I want to keep an eye on those stocks that have not corrected a lot. So I use the idealist filter in MarketSmith India app, and if you go to filter India stocks and select the criteria. So what I like to do over here is only keep an eye on stocks which have very strong earning strength. So I have selected great and good over here. And then those stocks should have a buyer demand of A or B. Now, this is very important, because when the mid cap and small cap have corrected 13 18% from their all-time highs, you would like to see stocks that are, even though if they have gone down, those stocks should go down on low volumes, right? So you can always see that there is not much of distribution happening. The institutions, the large money managers, are holding on to their positions in the stock, and few retail investors or few short-term investors might be getting out of it. So that's the reason why I keep buyer demand at high, that is A and B. And the other items that I have applied over here, so of course the average Ruby volume should be there. Now, if I'm just looking at small, mid cap and large cap, that's why I have selected it over here. So average daily volume, average Ruby volume is very important, because you want the stock to be liquid, you want it to be traded frequently. And apart from that, what another filter that you can apply over here is of the off high filter. So off I filter over here. So this will only screen stocks that have not corrected more than 10% from their all-time highs. Now, when I do that, I am getting around 42 names over here, and then I would like to sort them on the basis of, let's say, percent of high and in descending order. So the ones that are close to their highs will come up again. So you can see all the good quality names that are coming up over here, Edelweiss, Pidilite Industries, and so those are the ones which you need to keep in your watch list. And if you see whenever those stocks are breaking out, you can always keep a price level at which you would want to get into it. All right, so next up is, so I'm getting a lot of queries right now, and it could be possible that I missed them. So I'll try my best to answer as many queries as possible. Okay, so Amit has a follow-up query as to how did we identify that the stock has broken out? Is it 50-day moving average? So Amit, in MarketSmith India, you will see we have a proprietary pattern recognition technique which will draw automatic chart patterns for you. So in Edelweiss, as I had showed, there was a consolidation-based pattern. So with MarketSmith India, you can always see those patterns, and we don't use the 50-day moving average. We use the pivot price, the concept of pivot price. So basically, the previous level at which the stock had faced resistance, so that becomes the pivot price. And once the stock goes above that level, it qualifies as a breakout. Okay, Satya Prakash has a query on what's the frequency of updating of idea list and its score update on, is that weekly or daily? How can we come to know that list we are seeing is updated? So from MarketSmith India perspective, the lists that you see over here, all are proprietary ratings and rankings. Now, if you look at EPS rank, that is something which is updated not very frequently, mainly because the companies report results in quarters. So once the quarterly results are out, that's when the EPS rank gets updated. But all our other ratings, the technical ones like the relative strength, that is price strength rating, the buyer demand rating, industry group rank, all of these which are price sensitive get updated on a daily basis. So the watch list which you will be updating, that will show you the most recent ratings only. Okay, so next query is regarding HPCL for long-term investment. So long-term is something which depends on a case-by-case basis. And from canceling perspective, what we do is we want to hold a stock until and unless the uptrend is broken, or there is some really fundamental weakness that's happening in a stock. Now with HPCL, what happens, because these companies are PSUs and the government has a lot of say in it, even to the oil prices, if they're going up, we could have a situation like we had during Karnataka elections when the prices were not increased for almost 2 weeks. So we could have such situation as well, and all these things will really impact the financials of the company and will really impact the growth prospects. So we also had a news couple of days back saying that there could be a windfall tax that could be placed on all the oil marketing companies, and when that happens, so that could be there could be a scenario where once the crude oil price increases above say 85 dollars per barrel, the companies will have to pay some sort of dividends or some sort of all those extra earnings to the government, and the government will then provide as subsidies. So all those things can happen with these PSU companies. So from long-term perspective, I wouldn't say even, not only for Hindustan Petroleum, for any other stock, the fundamentals can change quickly. The business model can, the business environment can change quickly. So you need to keep a look at it, and that's where technicals help. So even if you had Hindustan Petroleum, if you had seen a breach of 50-day and 200-day lines, you would have got out of it, and it would have saved you from the underperformance that has happened over the past 6 months. So that's very important, because as investors we have a limited capital in our hands, and once you see that, suppose you have invested 1 lakh and that's underperforming and it's not doing much, you can always use that money in making extra money in some other stocks. So you can deploy your capital to more better opportunities. All right, so I'm getting a lot of stock specific queries now, and now what will happen is, since there are many and those are across the market caps, and those stocks might not be there in our universe as well. So all I can do is answer more from a technical perspective, because from canceling methodology, what we do is we get into a stock or we get out of a stock mainly based on technicals. Of course, our stock selection is purely based on fundamentals. So is Questcorp a good buy, having bounced back from its 50 DMA? So Questcorp, no doubt about its fundamentals, really high growth rates, very high growth stock, and that's the reason why it's a high beta stock as well. And you can see how Questcorp has bounced back from its 50-day DMA. That's a very good sign. But you can also look at the volumes, and there has been a dry up in volumes. So the bounce back hasn't come on huge volumes, and we would like to see when a stock is bouncing back from its 50 DMA, like somewhere it had happened over here when it bounced back from its 50 DMA and also broke out. The volumes were huge, and that suggests that there is some huge institutional buying that's happening in the stock, and that's where you should get interested. So right now, with the market also not giving clear signs of direction, my my opinion on Questcorp would be to still stay out of it right now, because it's not an ideal buy point. Also, the ideal buy point is, of course, when a stock is making a new high, all investors are sitting on profit, it faces least resistance. That's when you want to get into a stock. But during when the markets are choppy, you'll obviously see a lot of stocks that are breaking, that are rebounding from the 50-day lines, that are coming back above the 50-day lines. But again, they will face overhead supply from here, and they might go back below it again. But if the volumes were high, if there was really good buying demand over here, I would have suggested, and of course, if the market was also in a confirmed trend, I would have suggested getting into Questcorp, but not right now. All right. So there's next query from Achala. When MarketSmith India will update the app which shows price rise in percentage along with amount of price rise? Okay, so so what happens over here is, as you can see in Questcorp, you can see that the stock was down 0.2% in today's session. Of course, the closing price, by the time it's updated, the closing price should be updated around this time. So this is the last traded price which you're seeing right now. Okay, will we have swing trader kind of service in India? Of course, we are currently working on it, and we have plans of getting a swing trader kind of service in India very soon. I think maybe in a couple of months' time, we'll have a swing trader service for India as well, like we have in the US. Okay, Amit has a couple of stock specific queries on LIC Housing Finance and Venky's India. So because of time considerations, I'll be just giving a very quick look on LIC Housing Finance. What I can see over here is that the stock has been in a downtrend for a long period of time, and from technical perspective, I would like to see LIC Housing Finance first building a base pattern, first consolidating in a base, and then I would revisit it. And talking about Venky's, the stock had broken out during February, if I'm not wrong, and had given some really good gains. But after that, it has been in a downtrend. And the good thing over here is, so this is a good example of a stock getting really good support at its 200-day line. You can see how the volumes have also picked up, and the down days have come on really below average volume. So this is a period when a lot of weak hands could get out of the stock. From fundamental perspective, I do know that the company has reported some really good growth rates in recent times. So that is something which is really good about the company. You can also see how the stock has been accumulated. So all those blue lines which you see above average buying that has happened in the stock in the past 1 year, that is giving signs of huge accumulation that has happened over the last 1 year. And on the downside, you can see whenever it's going down, the volumes are not pretty Great. So again, for Venki's, you can still, if you're holding on to it, looking at the 200-day support, you can continue holding it if you're sitting on a very good profit. But if this level is breached, the stock could consolidate for a long period, and the stock could even go down further. So I would suggest, if the 200-day moving average is breached, make sure that you don't get into the stock. You get out of the stock, and if you're considering getting into the stock right now, the 200-day rebound is certainly a good point over here, but then the stock has a very huge overhead supply. So from 4,700 levels, it has come down to 3,100. So there's a lot of overhead supply. Almost 30% correction has happened in the stock, and so you need to make sure, as the stock tries to go up again, a lot of sellers, a lot of investors who had bought at those levels will, dump the stock, thinking that let's get out of it and make a break even, get at a break even price. So a lot of overhead resistance will be faced by the stock, and that's the reason why I wouldn't suggest getting into it right now. Okay, so we had recommended, so there's a query on why did we recommend pharma companies. So whole pharma industry is not doing good, that's certainly correct, and the industry group rank is also not that great. But we had a couple of pharma companies. So Abbott India is one which we had recommended, and the main reason for that is, even in such a period, the company has been able to maintain really high growth rates. It also has over-the-counter products which are mostly FMCG in nature. So that is also something which is playing out well for Abbott India. So the high growth rates and the stock breaking out into new high ground. So it's a multi-year breakout if you look at its weekly charts. So that's something which really caught our attention. Apart from that, we saw some increasing fund ownership and huge accumulation that was happening in the stock, and that's the reason why we have recommended Abbott India. And if you look at its performance, when the mid cap and small caps have done really badly, the stock has managed to hold up well. It's up 3% from our addition price, and that's something which is not really bad in the current market environment. All right, so due to time constraints, I won't be able to answer other queries, but what you can do is you can surely raise your queries using the Ask MarketSmith feature and send it to us, and we'll be happy to answer them. And we'll be having our next webinar on June 12th. So thank you very much for joining into today's webinar. Really appreciate that you guys took the time out and joined our webinar today, and I hope it was useful for you. And we look forward to interacting with you all in our next webinar. Thank you very much.